Welcome everyone to Qapita's next LinkedIn Live, and today's topic is all about financial reporting and disclosures. So I'm joined here by my colleague Evelyn, and today I think we have quite a bit of things to cover, considering we are in January, and in many jurisdictions, year-end has passed for 31 December. In others, companies may be preparing for their year-end reporting and the audit cycle. So my name is Amit. I look after the Southeast Asia, Australia, New Zealand part of the business. And I'm joined here by Evelyn, who's leading our international valuations and financial reporting function at Qapita. So hey, Evelyn, how are you? Good to have you here with us today.
Hey, Amit. Hello. Cool.
So would you mind telling everyone who joined us today a little bit about you, about your role within the company, the kind of work you do, and how you support our clients all over the world?
Sure. So, hey, everyone. I think as Amit mentioned, I essentially lead the international valuations and financial reporting function in Qapita here. So I've been here for about 3 years now. And in terms of the kind of work we generally do here at Qapita, we essentially mainly help private companies with their expensing and finding the value of their ESOPs, mainly for the financial reporting purposes. What we also do is share valuations as well. So we have 409A requirements. And sometimes we also help public companies, so listed companies who already have their share prices on the exchanges, but still ultimately need to find the fair value of their ESOPs for financial reporting itself. So all in all, this is pretty much just circling back to today's topic on financial reporting. We are quite heavily involved in this space, have done quite a number of engagements across the various regions, like in Southeast Asia, in India. We've also started working on other parts of the world as well. And mainly just here to help assist everyone with their financial reporting.
Yep, awesome. All right, so it's a pretty complex world, and ultimately the rules and regulations kind of differ all over the place. So maybe let's start with the basics, because in our audience we have people dialing from Singapore, India, US, Australia, all over the place. And obviously they operate in different kinds of industries, different kinds of businesses, they offer different kinds of plans. But to start off with, what's the overarching concept? Why, if you as a company give away equity to your employees, why do you have to care about financial reporting valuations? How does it all work? So what's the one-on-one introduction to this topic from you?
Cool. Yeah, so essentially, I think the main concept over here is that there are a couple of accounting standards across the world, right? So you have your US GAAP, your ACS 718 in the US. Across the world, everywhere else, there's what we call the IFRS 2, which is essentially the International Financial Reporting Standards. So according to these particular accounting standards, if you as a company were to give out any equity compensation, so this could be in the form of ESOPs, other instruments, etc., you would be required to actually expense them on your books, because ultimately it is seen as compensation. So similarly to how you give out salaries to your employees, those appear on your financial books as well. So all these kind of equity compensations, they also have to be reported in some form. But the question there is always then okay, what exactly would be the value that you record into your books itself? So ultimately, in the end, right, these accounting standards are there because you have to actually expense all of this in the books. And as a result, here we are in terms of how exactly can you define that value, arrive at that value, and do your reporting properly.
Yeah, makes sense. So I guess if I put this in a nutshell, is that whenever you pay someone salary, wages, bonus, pretty straightforward. There's a dollar amount or whatever the currency is, and that's what you expense as a cash expense to the business.
Mm-hmm.
So that's what a lot of people understand. If you give equity, there's no cash leaving the door, or at least immediately. However, there's still a non-cash expense that has to be recognized. So there's steps involved in that. You need to determine the value of that expense. So what's the total expense? And obviously, the next is the financial reporting, is over which time should that expense be amortized. So I think that's the concept. So I think that's hopefully well understood. And I think it's important for everyone in the audience, because some of you may be doing this on a day-to-day basis. It's pretty straightforward for you, but a lot of people may be joining from HR functions and reward who may not be too familiar with the finance function and their requirements there. So I think we'll try to cover both very technical stuff and also provide some high-level context throughout this conversation. So next up, Evelyn, I think you mentioned different kinds of plans and instruments. So they're not meant the same. There's options, there's other instruments. So do you want to give us sort of high-level overview what kind of different plans in general there are? What are the nuances? And then I think on the back of that, we'll explore what it actually means from kind of the valuation and financial reporting point of view.
Yep, sure. So I think in general, there are a couple of instruments that we commonly see in the industry here. So if I were to essentially split it down to just 5 overarching kind of instruments, you have your options, which is pretty much your ESOPs in that sense. You have your RSUs, your performance rights, your share appreciation rights, and also the RSAs. So of all these 5 over here, right, 1 to 4 on the screen there, these are essentially your equity-based instruments. And then the 5th one would then be your cash settled kind of instruments. So the difference here is that, okay, like for example, for options, RSUs, PSUs, RSAs, ultimately there is an underlying share beneath these instruments that it's going to be given out to the employees eventually. So for example, the difference between like options, RSUs is that like for options, you actually have to pay an exercise price. For RSUs, pretty much after vesting, you don't really have to pay anything. You get the share in itself. Then performance ones, like PSUs in that case, these are basically like RSUs, but with performance kind of conditions to the vesting instead. And RSAs are pretty much like actually giving the shares upfront, but then across time which is like the vesting in that sense, you essentially earn the shares, you lift the restrictions on these. So because of all these 4 instruments, they are equity settled. So they do underlying have like a share underneath them. But for the 5th one, which is like our share appreciation rights, phantoms, these are ultimately cash instruments because they only track the share price of the share itself. But in the end, whenever the employee like redeems these instruments, they ultimately just get cash. So the key difference between these instruments in terms of like financial reporting here, right, is that for equity settled instruments, you only have to find the fair value of these instruments as at the grant date itself. So it's a one-off kind of like expense that you're discovering, and then you just expense it across the life of these instruments. The thing about the 5th one, which is the cash settled instruments, is that because ultimately employees are going to be receiving that cash, right? So it falls under the category of liability accounting. What that also means is that basically you have to revalue this at the end of every single reporting period. So your expense will track together with the market.
Yeah, understood correctly. Yeah, so ultimately, if it's equity settled, there's a certain set of rules that apply for accounting. If it's ultimately going to be a cash payout as well, so accounting standards dictate that it needs to be treated as a liability because ultimately you're going to pay a sum of money to the individual. So the rules are not quite the same. All right, so that makes perfect sense. So I think hopefully that gives everyone a bit of clarity. So I think what we'll have to do next is kind of do more of a deep dive. Is one of the things you mentioned is that once you give away equity settled share-based payment instruments, so options, RSUs, for example, you need to determine that value of it on grant date, which in accounting standards is often referred to measurement date. So would you mind kind of walking us through what that process looks like? So what did the accountant say? How do you go about determining that fair value in a grant date? How does the valuation work in that sense?
Sure. So essentially, if we just focus this discussion a little bit on the ESOP side of things, right? We'll just use that as a term for going forward. Essentially, because you're finding out the fair value of these instruments as at the grant date, there are going to be like certain valuation models to actually discovering this. So the 3 most common ones we would say in terms of valuing your options would really be your Black-Scholes, your binomial, and then if you have any market-based conditions, that's where Monte Carlo comes into play. So these are the 3 most common kind of models. Typically, industry standard is to really just apply Black-Scholes, so it's one of the most popular ones because it's relatively more simple to execute, and generally the difference between the Black-Scholes and the binomial value doesn't change much. The caveat here is just that let's say if your options that you're giving out, the ESOPs that you're giving out, tends to be exercised earlier on. So you allow for this like flexible exercise kind of idea. So once they fall into the idea of like American options, essentially, then a binomial would be required to be able to factor for this early exercise inside.
Yep.
And then Monte Carlo, as covered as well, essentially it's required only when you have a market-based condition to your vesting. So then you actually have to simulate how the market might change over there. So essentially you're running like 10,000 simulations, 50,000 simulations, etc. So that's the part on the option valuation in particular. But as part of the inputs to the option valuation, you also need to actually discover what is the share price of the company, the underlying share essentially. So for public companies, this is pretty standard, right? It's pretty simple. It's already available on the exchange because it's listed. But so for private companies, this is where the challenge that we see comes into play. So ultimately, these are not companies which are liquid. They're not traded on the market. So the price discovery there can get a little bit complex. It's not like you have transactions coming in and out all the time for private companies, right? So ultimately, there needs to be a valuation report done for the private companies as well. So there are a couple of approaches you can go to this. Like the most famous one everyone knows is like a DCF. But for a lot of early stage companies, this might not be too suitable. So we do have other valuation models like, comps, market approach, asset approach, EOPM backsolve, VC methods, etc.
Yeah, for sure. All right, so that's quite a bit of information. So I think there may be some follow-up questions from the audience, but I might start the ball rolling. So if we go back to the option pricing model, so Black-Scholes is appropriate in a lot of cases. Binomial can be utilized as well. But Monte Carlo, what you mentioned is something about performance conditions, right? So I think it's a quite important nuance because a lot of plans may have service and time-based conditions as a default. So you stay with the company for the vesting period, you earn those awards. But in certain circumstances, company attach the performance hurdle, so performance conditions. So could you clarify what's the difference of non-market and market performance conditions, and maybe some examples for the audience? Because I think it's important because any performance-based plans, the need for Monte Carlo is a lot more complex. So I think it's important to know in which cases they may be required.
Sure. So the way we classify non-market and market conditions is ultimately whether the key question is just, does the vesting condition depend on the share price of the company ultimately? So let's say, for example, if it's a performance condition that is tagged to maybe a salesperson's KPIs, or perhaps as a CEO, okay, I want the company to grow, have a revenue growth of 30%. So that would not be a market condition itself because ultimately it's conditions, it's KPIs over here that can be tracked without relying on the share price of the company.
Yes. Okay.
But let's say, for example, if the market condition, the performance condition here is like, okay, you only vest if there is like an IRR of 30% achieved upon IPO, for example, then that, because it is ultimately tagged to the performance of the shares of the company, that would be a market-based condition.
Understood. All right, so that makes perfect sense, right? So if we kind of put it in a timeline for this whole mess to make sense for anyone trying to understand it, essentially once you give equity away for equity settled grants, the measurement, which is the grant date, that's we need to measure it. To determine the fair value of those awards, you can utilize one of the option pricing models displayed here. But before you can run the model, you need the input, right? And this is why you also need to know the input of underlying share price of that instrument. So usually ordinary shares, common stock, equity shares, whichever way it's referred to in your jurisdiction. So that's why you need to take this step. So in the public space, pretty straightforward because you can look last close, VWAP, and the information is publicly available. But for private clients, you still have to go through that process. So in a way, for you to kick off the evaluation process, the share evaluation model will be step number one. And that serves as an input into your step number two, which is the fair value of the awards you give away. Okay. So is that summary fair, Evelyn? Does it make sense to you?
Yep. Perfect.
Yep. Okay, awesome. All right, so we've kind of figured out step number 1 and 2, which brings us to the next step, which would be all about the actual reporting. So let's say we've given everyone a whole bunch of options. We have determined the fair market value of our company, whether it's listed or unlisted. Then we run a valuation model, option pricing model, let's say Black-Scholes, to determine the fair value. So let's say both of us receive 10 options, fair value is $1. So now we have total expense of $20 that we need to do something with. Right? So now the topic of this kind of conversation is year-end share-based payment financial reporting and disclosures, right? So do you want to provide some high-level context into sort of what the companies need to do with all this information? So relations are done. What happens next?
Cool. Yep. So after the fair value of the ESOPs or your equity compensation plans are actually calculated there, you essentially have to expense it, right? But so the idea here is that for all these share-based compensations, you don't actually have to expense it all 100% upfront. Actually, right. So you essentially have to expense it across the vesting or rather the life of these options itself. So let's say, for example, if you have a 4-year vesting kind of option, then you essentially vest it 25% or roughly around 25% each across the various life of the ESOP itself. So we actually do have an example, a little bit of a worked example over here, which we can illustrate how this would work. So perhaps maybe if we could pull that up.
Okay, let's do that.
Yeah, cool. All right. So let's say, for example, in this case, right, you have an option over here, which was granted on the 1st of January 2023. And there's essentially 3 tranches to it. So it's like a 3-year kind of vesting schedule. And so the vesting date over here would be the end of 2023, 24, 25, right? So let's say, for example, we've already gotten the valuation reports done out of the way. You've found the fair market value of the underlying shares. Resultantly, you've also done the necessary option valuation and found the fair value of each tranche of options itself. So once we figure out the fair value of each tranche of options over here, we essentially just have to expense it. So remember how we said that essentially you just have to expense the options according to the life of the options themselves. So in this case, that first tranche, the life of the options is essentially from the grant date to the vesting date, which is 1 year, right? So what that means is that in the 2023 itself, you actually expense the full 100% of the total expense. And then you come to your second tranche over here, whereby the life of the options is essentially from the 1st of January 23 to the end of 2024 itself. So it's across 2 years. So what that also means is that in 2023 itself, you only have to expense half of it, which is from 1st Jan 23 to 31st December 2023 itself. So that's one year of the 2 years, so that's half. And then similarly in that same pattern as well, for the third tranche over here, since the life of it is effectively 3 years and only 1 year has passed now, so you only expense 1/3 of it, which is this $26. So your total expense for this particular grant in 2023 will be the sum of these numbers, which comes up to just 159 over here. And then subsequently, then let's say if it's in 2024 now, so how would the expense look like, right? Essentially for the first tranche, because the full amount has already been expensed, you don't have to expense it anymore. It's already fully vested. And then now when we come to the second tranche, now it gets fully vested. So the full life of it is up now. So that's why you just expense the remaining half of it. And then for the third tranche over here, only 2/3 of the way. So that's why 2/3 of up to 2/3 of it should be expensed. We already expensed 1/3 in 2023, so now another 1/3 goes to 2024. And following that same pattern, then you can figure out that 2025 would just be the remaining 1/3 of the last tranche. So this would be how your ESOP amortization schedule looks like. And effectively, it's just what you have to remember is just that it's all based on each tranche of the options per the vesting schedule itself. And depending on the life of each tranche from the grant date to the vesting date, that would be how the proportions get cut across the years.
Okay. All right. So I think that was a super helpful example. But yeah, one thing you made very clear is that valuations and kind of reporting is done at the tranche level. So if one individual receives 30 options in this case, you kind of have to treat each tranche as individual grant on its own. And this is dictated by IFRS 2 share-based payment expense accounting standard. Important to note that this not necessarily may apply to everyone listening to this, because ultimately your local jurisdiction and accounting standards you follow may be a little bit different. One notorious and I think famous example is the difference between sort of US GAAP and IFRS, is that companies in US that follow local accounting standards and do the reporting under AC 718 can in theory apply the straight line expense and do it at the grant level, which is a pretty big difference here as well. So it's just important to illustrate that this example is obviously oversimplification of how things work in process, but hopefully provide illustration should your company follow IFRS 2 or a local similar standard that's been adopted from the international standards. Okay, so I think that makes sense. But even I guess in practice, like it's never as simple and straightforward, right? You're never going to have grant dates at the start, vesting dates at the end, and everything is nice and tidy. So are there any like weird scenarios that usually come into play? So if a company is preparing for their 31 December reporting or they have a year end coming up, what are some of the practical things they need to keep in mind as they kind of finalize their year-end reporting?
So I think one thing we've also come to realize with a lot of startup companies as well is that like the common practice is you don't really think too much about the impact of this particular financial reporting when you're giving out the ESOPs. So what we tend to see is like a lot of different grant dates. That could also mean like, you know, we have 365 days in a year. It could really be like 100 different grant dates in 1 year itself. So this has an impact into your financial reporting because ultimately there needs to be the fair value discovered as on each grant date. So that can come as a complication. But so knowing this, some companies decide that, okay, now that I know this for this year, next year I'm going to change it up. So they're going to just grant everything on one particular date itself. But because ultimately sometimes companies are like basically granting these ESOPs to actually reward like employees who are joining, for example. So their start dates are all different. So what they do to make it fair is to adjust the vesting schedule instead. So let's say, for example, if my grant date is in 1st of June 2024, but maybe perhaps my effective vesting start date would be like that first cliff of that first year actually becomes 1 year after my joining date, which could be, you know, 31st March 2025, for example. So because of that, even if all your grant dates are the same, but all your vesting schedules are different, that would also play a different part in terms of the valuation of the ESOPs, and also in terms of the reporting, the financial reporting for your ESOPs itself. I think the key thing to remember here is that, like, in terms of financial reporting itself, the grant date matters, but also the vesting dates for each tranche also matters. So in that case over there, right, if you have a lot of different dates like that, then the complication to the valuation and the complication to your financial reporting gets a little bit higher as well. So it's just something to take note of. Standardizing it might be better. So it's really just trying to get this balance between what's fair for the employees and what would be easiest for the administrative side for the company as well.
Yeah, for sure. Yeah, ultimately there's trade-offs and a lot of plan design, considerations. So that's why HR, finance, and reward team always have to work together in this, because what decisions made on both sides will impact the other. And ultimately, plan design decisions are quite important. But once again, just want to caveat here that the nuances and things you can do will be kind of dictated where you are. Like, in examples of if you're an Indian company giving equity to your local employees, you may not have flexibility to adjust the cliff because they have the mandatory 1 year cliff period, so you can't do it lower. So once again, there's going to be constraints from accounting standards, from local regulations as well. So if you have any specific questions, more than happy for you to reach out to us. We'll help guide you through that. So to kind of wrap up, some of the conversations around financial reporting. So kind of recap. So we've granted a bunch of stuff to our employees. We've understood what the underlying fair market value share price of the instruments they'll ultimately receive. We determined the fair value of options, RSUs, or any other instruments we've given away. We know the total expense. We know we need to report it on annual basis. So let's say we're doing the 23 report. All the numbers are ready. You've kind of prepared your total expense to be booked in your P&L. Do you want to talk us through, Evelyn, about what happens next? So we have all the numbers. When you submit it, you get audited. How does the process look like? What are some of the things companies need to keep in mind?
So I think in general it's just after this as well, like after everything is done, then pretty much your audit period itself is over here. Generally, this whole process itself takes a while because ultimately it's a whole valuation. There will be a lot of communications between the valuer and the auditors as well in terms of closing off all of these books. And once your books for this year is done, then there's always still next year in that sense, right? So in that case, like I guess closing thoughts on this would just be that like whenever since we're at the start of the year now, in terms of reporting for FY23 that has passed itself, that's already done. We will just have to work through it as what we can. So just to note, if you have granted out your ESOPs in FY23, you might be due for some form of audit on your ESOPs itself. So just check in with your auditors, make sure if you are required to actually report these, then we're also here to help you if you need any assistance in terms of getting your expense there. And then going forward for FY24, just general advice, now that you know if you're going to be giving out your ESOPs over here, might want to actually consider certain things in terms of like the plan design here and there, when to grant, how much to grant, how are the vesting schedules looking like, and in general, the common consensus here is just try to keep things as neat and tidy as possible. Best not to do it across the entire year at every single period.
Yeah, you might want to get creative with daily, hourly vesting, things like that, which sounds good on paper and maybe super employee friendly, but then the trade-off is that your finance team might not be too happy with extra work they have to do. All right, so that makes
Very
sense.
true.
And I think the thing you mentioned catches a lot of people by surprise. Sometimes you give away equity, nothing's really vested, no one cashed out or transacted, but you actually have to already start amortizing it from day one, right? Which is an important takeaway. Even one more final question around the whole financial reporting audit. There's also some disclosures that may be required as well as dictated by accounting standards. We don't need to go into too much detail, but what kind of things that a company needs to keep in mind, and what kind of information is usually requested as part of this requirements?
So normally as part of the audit itself, whenever you close the books and report these expenses, there are a couple of disclosures that you need to put in there. So this would be like, for example, the opening balance, closing balance in terms of how much has already been granted in the company. And then you also want to figure out like, okay, we have discovered all the fair values of everything, but ultimately you don't report like every minuscule detail onto your financial reports, right? So for example, what's the weighted average fair value that's been given out so far? All these kind of like, essentially it's reporting the profile of your ESOP plan, what's been given out, how much is being expensed, what's the value of it, etc. So these disclosures can be a little bit troublesome. I mean, like you've come all the way here, right? You've done the valuation, you've done the whole schedule. Now you have to even do the disclosures. So it can get a little bit troublesome to do, especially a lot of manual work, which is also why we do have a couple of tools online here and there, which can actually help to ease the whole process.
Well, I'm glad you brought it up, and it wasn't scripted at all. But Qapita actually does have a pretty good tool. So maybe to wrap up this session today, we're more than kind of happy to show sort of take you backstage to see how the process actually looks like, right? And for us, we definitely do have a platform available that we utilize, and this is something Evelyn and the team uses in the background to go through the process and make all the manual work and all the drops a little bit easier. So within our Qapita platform that's used by many startups around the world and listed companies, we have our financial reporting module. And within that, as we're kind of briefly showing you, is that we're able to capture essentially all the rules that Evelyn was talking about based on accounting standards. So what is the reporting year? Any reporting that needs to be done based on entity level, because as part of accounting, you might need to apportion expense by business unit, cost center, countries, divisions. So that's also something relevant for you to see. In order to be able to calculate expense, you obviously need to capture all the fair values and define that logic to use. So that tranche level graded amortization that Evelyn is talking about, dictated by IFRS 2, can be set up in the system, right? And your calculations can be done as granular as daily, if that's something what you want to do. And the disclosures that Evelyn alluded to, all those disclosures can be automatically calculated if you have all your equity award data on the platform as well. So the way the process works, the way we manage it, is for all the companies we work with in support and financial reporting, we kind of set up all the overarching framework and logic in line with accounting standards. And what it allows us then to do is to capture those relevant fair values for all their employees. So for any given employee, we're able to keep track of all the awards they've received, all the relevant tranches, all the underlying details. So when was the grant date? What was the exercise price? When did it vest? The example that Evelyn gave, that in some cases we want to start expensing not from the date of grant, but a little bit earlier from the joining date. So that's something we can capture as part of grant date of accounting purpose. And then ultimately, the fair value is recorded against every single tranche. So what it allows you to do, because within the system we keep track of all the grants, all the quantities, what's been forfeited, cancelled, exercised. We have the vesting schedules as well. And what by inputting the fair values from the valuation report that we can also help you put together, we can understand the total expense. So the next thing is to generate the financial reports for the relevant period in time. So as you can see here, you can run your monthly reports, daily, annual, you do forecasts for future periods in time. And it's important to consider that if something you've been expensing manually in Excel or Google Drive for the last couple of years, what we can help you do is capture the historical costs as a starting point in time. So for example, we can take all your life-to-date expenses at your previous reporting periods, create a snapshot as in this case 31 December, and use it as a basis to generate the reports for future periods in time. So anytime we help you create a report, and whether you want to utilize it yourself or rely on our analysts to do that, if you want to run your FY24 forecast, you can select the base report, and let's say it could be your year-end 31 December expense report snapshot. You can record it, expense for the next month, next quarter, next year, whatever the relevant period is, and run that expense report. Some of the things that also be relevant, you might want to do some attrition assumptions based on the data that you have, input forfeit rates, and record the expense accordingly. So long story short, what I wanted to introduce you to is a series of relevant concepts and that are relevant not just for the finance team responsible for preparing the reports, doing the evaluations, but these are all the considerations that HR leaders, payroll, reward teams, even founders need to be mindful of, because the design decisions, how you run your program, will ultimately impact this. These are all the obligations that are mandated by accounting standards, and as you prepare for your year-end audit, this is something you'll need to be mindful of as well. So I know there can be a lot of questions. It's a pretty complex area. So if there's something you're not sure about designing investment schedules, getting valuations done, how the expensing reporting works in practice, or if you're already using our platform, kind of want to explore that, more than happy to jump on a call. You can reach out to Evelyn or myself on LinkedIn. If you have our emails, you can do that as well. And we're more than happy to have a chat with you, see how we can be of help. So with that in mind, so Evelyn, thanks so much for your time. That was super helpful. Always like talking to you. I think the light turned off, so it's a sign for us to wrap up in the room. So I appreciate everyone dialing in. Hopefully that was of help. Keep an eye on future LinkedIn Lives that Qapita is hosting on the range of topics. We do a lot of educational events, discussions with our customers, partners, everyone across the world. So thanks for joining, and see you next time.